Welcome everyone to the sixth lecture of the discussion on macroeconomics. In today's lecture, I'll be talking about, as you can see, about money, banking, and demand for money. We'd be trying to build something called a liquidity of money curve, understanding all these, but keeping in mind the background of this study is still under the aggregate demand that we had been discussing throughout the lecture 5 onwards, and this is again an extension to that. So the first part of today's lecture would be largely the introduction to monetary market and how money market works, or rather how money as a commodity functions within an economy. And after we have understood that bit of it, a little bit of introduction to the Indian economy and Indian central banking system I try to bring in. And after these nuances are a little more clear, I'd straight away go into the Keynesian understanding of a money demand function and how these money demand functions eventually fits into the aggregate demand curve that we are discussing about. And then again, just to remind you that the whole of this discussion is to explain the short run fluctuations that is happening in an economy. So we started with the short run fluctuations, we have understood recession, and we have gone through the classical macroeconomics explanation of it, or rather the lack of explanation that was coming from the classical macroeconomics part. Then between 1929 and 1933, the Great Depression of Europe and United States happening, and John Maynard Keynes trying to explain that by a short run aggregate demand theory, and how aggregate demand might often explain, or the fluctuations can be explained through aggregate demand. So the goods and services part of this aggregate demand comes from the investment savings curve, or IS curve, that we had discussed in the previous lecture. And based on that, we have now understood that rate of interest and income are the national income are related through the goods and services curve in a negatively sloped IS curve manner. And today we are bringing in the monetary part of it, that what brings the monetary market or money market in equilibrium. And today's lecture would largely be in two parts. So in the beginning, I discuss a little bit about what is money, what are the functions of money, how in an economy the quantity of money or the money supply is being controlled by the central bank. Particularly, we discuss about the Reserve Bank of India's a little bit of policies today, and then we'll try to understand how money is entirely related to the price level of an economy, at least in the short run. And then eventually we'd go into understanding the LM curve, or the theory of liquidity preference of Keynes. So let us first start with what is money. That question, that it has remained very important, because up until now, the current day modern economy that we are seeing, historically, if we go back to it, there is a time we have all known of this time as a barter economy, or an exchange economy time. So say for example, if one needed a bag of rice and one had a bag of wheat or something, they would barter these two with an understandable bargained exchange rate. But the problem with exchange or barter economy is that if you need to do one or more amount of more than one transaction, then to make sure that this amount of a bag of rice is equivalent to, say, buy some other grains, or buy some other utensils, or so on and so forth, and many other items, the complexity of these whole transactions made sure that we uh, come to a common denominator through which we can have the transactions, through which we can have transactions throughout the economy. And that's when this concept of money also is evolving, or rather taking place. So there are three broad functions in today's money. The By money I mean the currency, as well as there are other forms of money that are serving. So the first thing that money, or broad, in broad terms, money does is it stores a certain amount of value. So if I give you a 10 rupee note, that means 10 rupees worth amount in the market you can buy. And if you're not buying, you have a certain value stored in your wallet or in your bank account, that you know that this is the worth of the value that you have. So therefore money always in the first place, it is a store of a value. And the value being, it's an exchange value that we are talking about. The exchange value eventually have some use values of goods and services that we are about to buy using that money. The second part is, it's also an unit of account. So when I say 1 rupee and 100 rupees, that means I can buy 100 units of 1 rupee worth goods and commodities or services. So if someone has 10 rupees and someone has 100 rupees, it means that there are 10 times more of these 10 rupees someone else is holding. So we necessarily express all our prices, all our cash transactions, all our banking transactions in terms of these unit of account. So once we get a message that your account is credited rupees one, like 30,000, 40,000, something like that, we know exactly what this rupees 30,000 means, because we know that 1 rupees is our unit of account in this economy. So in US it would be dollars, in other countries there would be other currencies, uh, but necessarily all monetary transactions that we are seeing these days are done through the currency that we have agreed upon as an unit of account for all these transactions. So money also serves as an unit of account. And the third thing, as we have the first two being the functions, the third thing is a practical thing that we are every day we are going through, is that money is the medium of exchange. We no more exist in an economy where barter exchange take place. We essentially buy goods and services from wherever, from our local markets, from our Amazon, from our Flipkart. We order these and we pay it in terms of money, and Amazon employees are paid their wages and salaries in terms of money. The delivery personnel gets his commission share or however thing that is in terms of money. So all exchanges that are taking place uh, are happening in terms of a currency unit or in terms of money. So these are the broad three functions that money serve broadly in an economy. Now, what are the different types of money that we have in an economy? And we have currency, as I have told, and these amounts in billions are coming from the US 2011 2001 to definitions. I am using these from the macroeconomics book of Mankiw. So currency is the basic liquid form of money, and by liquid we mean that the cash which can flow wherever it wants. So you have 10 rupees, you can immediately give it to me, right? So currency is the most liquid form of money, and that's the first form of money that we are aware of. The second form of money is known as M1. Now you see that if we see the quantity of money here, for currency it was a little around $600 billion, and now for M1 it now adds the checks and checkable deposits. So if we have a savings account in at hand, and we can issue checks. Now this is a time that we are talking about when checks were very much popular. Nowadays you have ATM card or something, that is also part of your M1. So your savings account money, which is immediately transferable to other accounts as not in the currency form, but can be immediately transacted in terms of the liquidity. So if we see it as a liquidity scale, after currency we add the checks and checkable deposits, we get M1. That's a little less liquid but than currency. But then comes the M2, the money market mutual funds, the money market depositing accounts, and savings deposits. Now here I need to remind you, it's not the same ATM savings account that we have, but rather we have, say for example, a 3 years recurring deposit, or a 2 to 5 years of mutual fund, or we have deposit accounts, demat accounts, and so on and so forth, where a little less than 2 to 5 years of time and we can get this money in a liquid form. We call it M2. It's a little more stringent, little less liquid in terms of money, but nevertheless the final, or M3, is these, that we have our repurchase agreements. So I own some land, or I own something, and for which I have got a repurchase agreement from a person that said that after 3 years I'll buy it from you. So I can use that, or I can use my house mortgage as something as money, and I can get another loan showing that. So these are all our agreements which can be termed as money, but it is the most stringent form, and this is the least liquid form of money. Then we have institutional money market mutual fund balances, more than 10 years of institutional mutual fund deposits we have made, and we know after 10 years or so we will get back the money, but right now it is the least liquid form of money. So these are the four broad categories that we use. RBI, this is from Federal Reserve of US. RBI uses quite a similar type of accounting process. So we have currency, then we have demand deposits for banks, and then we have other deposits in M2, and finally in M3 we'll have the post office, uh, like time deposits, as known as time deposits for M. So that will come in and around M3. So now that we have understood that these are the different forms of money, how do RBI, or Reserve Bank of India, which is the central bank, uh, influences, or rather how the RBI decides how much money or how much quantity of money to be flown into the economy. And there it is most important to note that if you take a banknote or any currency note in your hand, you'll see that there is a declaration by RBI governor in each of these notes, where there's a bearer sum of 10 rupees, 50 rupees or something. The assurance is always signed by RBI governor. So in India, if someone doesn't is not willing to take that 10 rupees note, which is in a I'm not saying if the note is torn out or something, but if it's a note and if someone is denying you that they won't take it as money, there's this RBI's assurance which says that it will make sure that you gain the worth of money 10 rupees in Indian territory and wherever Indian currency holds. So the assurance of cash notes also gives permission to the RBI to print or provide money. Of course, in tandem with, it is always in relation with the central government, that how much cash notes are something that is to be provided. The second part is the how they create money, and it is not always by printing money. RBI does the money supply, or printing coins or something. It doesn't always happen like that. There's also something known as open market operations of RBI, and in which what they do is they buy government bonds or central bank bonds from the open market, and once we are buying the bonds from someone, we need to pay in cash to those who hold these bonds. And through that, if someone is buying it from me and giving me the bonds, therefore the cash now I am going to pay because of it is now going back to RBI. So that's a contraction of the money supply. It reduces the money supply in the economy. On the other hand, if RBI needs to uh, infuse, or if it needs to inject liquidity of money within the economy, what it does is it buys back the bonds from general public, and thereby the cash goes back to the public who had earlier been holding the bonds. The other two measures that are used are known as bank rates. You might have already come across repo rates, through which RBI lends money to the commercial banks. Now, the commercial banks which are nationally registered are also asked to maintain two particular ratios. The SLR means statutory liquidity ratio, which means if you have a reserve in your bank, you cannot provide loans or cannot have liquidity more than a certain percentage of your total bank reserve. And the second part is known as the cash reserve ratio. So out of that liquidity, how much cash or currency form uh, you can provide to the general public, or how much reserve is need to be kept, that is also dictated by the RBI's norm. So these three, so the first part, that is seigniorage or printing money, the second part open market operations, and then third is several bank rates, be it repo rate, which RBI lends money to the commercial bank, or the reverse repo rate, through which RBI takes back money from the commercial bank, and then by maintaining the statutory liquidity ratio and cash reserve ratio. These three means are through which the central bank in India controls the money supply in the economy, and it is thereby the quantity of money that is supplied by the Reserve Bank of India in our economy is essentially exogenous. And by exogenous I mean that it is completely up to RBI that to what extent the money supply is allowed, or it is to be uh, controlled, or is to be verifiably protected by RBI, because and that's why in the throughout our discussion we'll take the money supply, which will express as capital M, is exogenous and it is controlled in the short run by the central bank of any country. In Indian scenario, it is Reserve Bank of India. Now coming back now again to theorize the understanding of money supply and how it is related to the economy, we have a theory of money which dates back to the classicals, and then again there is a Keynesian explanation to it, but nonetheless this theory of money is known as quantity theory of money, and it's a simple theory which links the inflation rate or changes in prices to the growth rate of money supply, and starts with the concept of velocity. Let me start with what velocity is. So we start with the quantity equation, which was earlier suggested by few of the Cambridge economists and later shaped by many other economists, which says money supply, which is the absolute amount of money supplied in an economy, is always equivalent to, so this is the price level of the economy P, and T is the total value of all transactions that you are having, right? Thereby, we have a concept of velocity, which is necessarily saying us that this is equal to Pt by M. So, if these are the total number of transactions and this is your level of prices prevailing, so this is the nominal amount of transactions in your economy, Pt. And if we divide that by the money supply or the amount of money that is injected into the economy, we get V. And V is known as the transaction velocity of the uh, money or the currency. Let's stick to the money or currency as of now as a similar thing. So why it is so? The basic generally it gives that the in an economy, it's basically if you have this particular amount of money supply given, and if you know the total value of all transactions, your velocity gives that how much the one currency has to travel for these equation, quantity equation or accounting identity to hold. And by velocity, it's again dates back to the goes back to the physical science idea or the physics idea of velocity. It is the same, that at what rate each of the currency has to travel in order for to the value of all transactions at this price level to prevail, given the money supply of in a certain year or a particular certain short run. Now since we cannot know the total amount of transactions in an economy, that's in an accounting procedure that becomes quite difficult. So the Cambridge economists, what they did, they substituted the GDP, real GDP, that is Y, in case of T. So now P into Y is our nominal GDP. So then velocity it essentially is giving us that the quantity equation, which is mv equal to py, where v is the income velocity of money. Earlier it was transaction velocity, now it is income velocity of money given the money supply, price level, and the nominal or the rather GDP of the economy. So now what is income velocity? What we can say that it suffices to say with a given nominal income of an economy and money supply, the velocity income velocity of money explains the number of times a currency or the supplied money has to travel in order to the nominal GDP and money supply be in this accounting identity, and this accounting identity is known as the quantity equation, where a money supply into velocity of money is always in equivalence to the nominal GDP of the economy, and it's an identity. generally holds by the definition of the variables. Now, bringing in, so now since we know that the money supply is always determined by, or this previous M is determined by the central bank, it is exogenously given. Now what determines the money demand, and which is the if we say that this is real money balances, means this is M by P. So in reality, given this is the price level, how much each of your currency can buy is can be provided by this M by P. And everywhere we are having real, this is the total money balances, and once we make it a real money balances, we divide it by the prevailing price level. So the from the quantity equation, we move forward to the money demand to define the money demand function. And by this theory, money demand function is essentially determined by the level of income of an individual or the total country. Why so? Because if I have more income, it is necessary, or it is more likely that I would like to hold more money. Or why it is likely? Because now I can hold more money because I know I have this much of income, and I want to hold a certain percentage of that income in my monetary real money balances terms. Or you can express it in this manner, that if someone has $35,000 income, uh, and that person wants to hold one-fifth of that income in terms of their money balances, so that determines the demand for real money balances. And this is again, K is exogenous because it depends in a particular economy, given the structure of the economy, how much money people wish to hold, or how much money, and this is the transaction motive, as we might say. They mean to do the transactions, how much money people wish to hold for each dollar of income is what K expresses. So K is the coefficient which expresses that for each dollar of income, how much of that income I want to hold in real money balances or in terms of cash. So now if money demand is determined by KY, we can see that income increases money demand. By increase in income, since this is the form with which I want to hold money, we know that it is, if income increases, money demand increases. And this has a certain semblance or resemblance to the quantity equation. How? Because we already know by quantity equation MV equal to P of Y. And mv equal to py brings us to this, that v can, if I can write v as 1 by k, I'll already, if I we have uh, m by p equal to 1 by v into y, therefore if we can put v equal to 1 by k, we go back to the money demand equation. So quantity equation also expresses money demand equation, where if people hold a lot of money relative to their incomes, K is large, and therefore money changes hands infrequently, and people are holding these cash balances. So there is this exchanges. The velocity with which money was earlier exchanged becomes smaller, and therefore the quantity theory of money now in the short run has two assumptions. One, that velocity of money in the short run is constant and exogenous. Thereby we get that mv bar meaning that it is constant, we go into something of a quantity equation where mv equal to py can be now written as mv bar equal to p into y. And again, I need to remind you why we started this, because we wanted to know how money supply is related to the price level or the real economy. So now if mv bar equal to p of y, with v constant and money supply, thereby determines the nominal GDP. And in the short run, the price level is determined by uh, mm, therefore the money supply. Why we are saying this? Because in short run, or in the small 1 year economy, we already know that real GDP can be constant as well. So mv bar equal to py bar, and therefore 1% increase in the money supply would determine the percentage of increase in the price level. We can write it in this way, that if mv equal to py, then delta m by m plus delta v by v is equal to delta p by p plus delta y by y. You can think of it as a logarithmic transformation, and then we are taking the differential in both the sides. So with these we can say that if this is the monetary growth rate, growth in monetary money supply, plus changes in velocity. Now we know velocity is constant in the short run. We also know y bar is fixed in the short run. So thereby the changes in money supply directly changes the price level. And this is something that was very crucial to the classical economics understanding, that money supply only changes the price level, not the real uh, income level. And why so? Because the real income is already determined there by the supply side of it because of the classicals. Now again, Keynes's departure from these is something that will come to. So but before this, so now we know that delta p by p is the changes in price level, and this is something known as inflation. So money supply causes inflation. How much does this cause the change in income level? We'll get to that using the Keynes's idea. But because before that, just to summarize what the quantity theory of money, it states that if the central bank which controls the money supply and it increases the money supply, it will eventually increase the price level. So and if it controls the money supply, or if it is tighten the money supply, then the price level will be stable, and thereby increasing the money supply rapidly, the price level will rise rapidly, causing inflation. Now, quantity theory of money, as I have said, it assumes that the demand for real money balances depends only on real income, right? But Keynes's assumption was that no, it is not only real income Y that was determining these, but rather another determinant of money demand is the nominal interest rate. And why nominal interest rate? Because of which that uh, so money demand, we now know that if the higher the income, I want to hold money or something, that is a positive relationship with money demand. But the interest rate is essentially the opportunity cost of holding money. Let me give you an example. If I have 100 rupees and whether I want to hold that money in cash forms or in currency form, or I want to put that in bank, it always depends on how the prevailing interest rate is. If the higher the interest rate, I am more likely I am to put it in bank, so that that money will earn uh, some amount of more cash reserves, uh, which will benefit my own account, rather than holding the money which doesn't earn anything. If I keep 100 rupee note inside my bag for 1 month, it won't earn any interest rate. But if the interest rate is higher, I am more likely, or if it increases, I am more likely to put money in bank rather than holding the money. So therefore, interest rate is negatively related, or interest rate negatively increasing interest rate negatively affects the real money demand. So now summing this up, we come to the theory of liquidity preference, which is Maynard Keynes's, um, I would say Maynard Keynes's inclusion of interest rate and income into the money demand function, where he's saying that interest rate is determined by money supply and money demand, and their interest rate also somewhat helps the money demand to shape. How does it happen? So let me explain this diagram a little bit. So in an economy, this is the real money balances. And by real money balances, we have to always keep in mind that this money, M is quantity of money, and this is the prevailing price level, right? Now money supply is something that is always fixed by the central bank. So it's a vertical line where we always know that this is the real money that is available to our economy, which is fixed by the central bank. But it is interest rate which determines the money demand, or L of R. Now how does it make sure that interest rate is determining the rate of interest? Think somewhere here, where interest rate is not in equilibrium, money supply is not equal to money demand. So in non-equilibrium, here we are seeing that the interest rate is much higher, but at this rate, somewhere in here, if you think, at this rate, if you see that the supply of money is less, is more than the demand for money, right? And interest rate is much higher. So at this rate, the demand for money, what I am demanding, is much less than what money is supplied or something, right? So eventually, if I have more interest rate, and so what I'll do is that people will try to, with more supply in money or something, and with if the central bank has supplied more money now, and if the demand for money is quite less, it is pertinent that the interest rate would adjust and bring back the economy to the equilibrium again. Because how it will do so, because now if my money for demand is less and the supply is much more, then what people would do, they would start saving the excess amount of supply of money that is over provided by the economy. And the more you start saving, the interest rate starts falling, and we go back to the previous equilibrium position, right? So here is this, now how central bank raises the interest rate. The central bank, once it raises the like it fixes the interest rate or the rate at which it will lend to the commercial banks or by open market operations. If it raises the interest rate to R2, the central bank will eventually, in the curve will shift back, the vertical curve will now shift back here, and will have a higher interest rate and a new equilibrium where the money supply is much less and the price level being the same, and the M2 bar is now quite less. Once it raises the interest rate, the supply of money would come back here, and at this in prevailing interest rate, the new money supply will fix somewhere here. Now let's put back y into the money demand function and see what happens. So now we have a money demand function where money demand is determined by interest rate, which negatively affects the money demand, and income, which positively affects the money demand. So LM curve, or liquidity of money curve, which is the second part of the IS-LM model that we are discussing to build up a model of aggregate demand according to Keynesian theory. The LM curve is a graph of all combinations of R and Y that equate the supply and demand for money balances. The equation, you can see that at any given point of time, at equilibrium, money demand is equal to money supply, and money supply is always fixed, M by P is always fixed, which is a function of rate of interest and the level of income. Now how do I derive the LM curve? We start with an increase in the income. So here we were at the level of, say, y1, and here we are at y2. So how it is expressed here in the market for real money balances? Earlier, the money demand function was here at LR. R is the rate of interest, and y1 is the initial level of income. Now if income increases, as we have already discussed, it increases the money demand. Money supply is already fixed by the central bank at the M bar by P bar level. Now if increasing the income increases the money demand at this level, the rate of interest increases, right? So we can directly see that an increase in income increases the money demand, which again increases the interest rate. This is what is exactly summarized in here, but mind you that both these points are always keeping the equilibrium intact where money supply is equal to money demand. So at LRY1 and LRY2, these R1 and R2 represents the equilibrium level of interest rate, and Y1 and Y2 represent the equilibrium level of income. But in the x-axis we are measuring income and output here, and the interest rate is in the y-axis. And what this LM curve then necessarily represent? It represents the money market equilibrium where money supply is already exogenously given by the central bank, and the money demand is a function of income and interest rate, and because an increase in income raises the money demand, and because money demand increases, to be in the equilibrium the interest rate also increases, which gives us a positive relationship between rate of interest and income. So the more the income increases here, more are the chances of increasing the interest rate. And through which channel this interest rate is increasing? The interest rate is increasing through the channel of money demand, that once income increases, people want to hold more money, and that is through which we derive the LM curve. So but necessarily then the LM curve slope means it's a positively slope. The intuition or the explanation is that the increase in income raises money demand, and since the supply of real money balances is fixed by the central bank, like excess demand in the money market at the initial interest rate, the interest rate must rise to restore the equilibrium in the money market. Now let us express this in terms of an algebraic formula. So this is money M by P of demand. Money demand is positively related with income and negatively related with interest rate. So EY and minus FR, and this minus sign necessarily represents the negative relation between money demand and rate of interest, and E represents the positive relationship between income and money demand. Now suppose money supply is fixed at as we know M bar by P bar. So using the money market equilibrium condition, we have money supply equal to money demand, M by P equal to EI minus FI. And this is exactly what the LM curve equation look like, right? So we have market for money balances, and the LM curve necessarily implies this. Now what happens if increase or the market for real money balances, there is an increase in the money supply, or the central bank increases the money supply to or decreases the money supply to a point. So if there is change in money supply or decrease, we have already seen that money supply will be here, and in order to reach to the equilibrium or keep the equilibrium intact, what we'll see is that rate of interest increases, right? And so in a shift in the monetary supply or money supply often shift the market for real money balances interest rate, and in the new interest rate given the previous amount of income, now we are seeing LM coverage shifted upwards, right? So a decline in the money supply shifts the LM curve leftward or upward, and an increase in the money supply shifts the LM curve rightward. And why so? Because to keep the equilibrium intact, the new equilibrium, to keep the y1 intact, the LM curve would shift leftward or LM curve would shift rightward given the direction of the change the money supply takes. Now again, to summarize, what LM curve now basically means is this. You remember for IES curve we had this equation where consumption was function of disposable income, investment was function of interest rate, and government expenditure was exogenously given. And now we have a money market equilibrium where money supply is always equal to the money demand. Money demand is a function of rate of interest and income. So now we know that how in money market income and rate of interest is related, and we know it is a positive relationship, and we know how in goods market the rate of interest and income is related. So combining these two, rate of interest and income, which simultaneously satisfy the equilibrium interest rate and equilibrium level of income, we come to the understanding of aggregate demand. So from Keynesian cross, a simple Keynesian model, we have arrived at IS curve. From the theory of liquidity preference, or the income increases preference for liquid or preference for liquid cash, we have understood the LM curve. Bringing IS curve and LM curve together, we get the ISLM model. ISLM model in turn determines the aggregate demand curve. Now if you just think of it, that for demand what we need is a relationship between price level and the aggregate output, and from LM curve now we have the price level at which money supply is equal to money demand, and from IS curve we know the rate of interest with which Y is equivalent to The goods market equilibrium is served. Bringing these two together, we solve the IS and LM curves simultaneously. We reach at a price level and an income level, which gives us the aggregate demand curve. There's another side of this big picture where aggregate supply curve comes, and these two together explain the short-run economic fluctuations. So where then Keynes is differing from the classicals, particularly because from classicals it was always the aggregate supply curve, which is determined by the level of production, the amount of growth that a GDP was going through, and not the particularly not the short-run aggregate curve fluctuations. However, Keynes brings in these two things where investment determines or inventories determines whether the ICE curve or the Keynesian cross equilibrium is served, and interest rate and income determines how much of the income level is or the money supply is needed for LM curve to be in equilibrium. IS and LM model together determines the aggregate demand curve, and thereby aggregate demand curve now has something to offer to the short run fluctuations. I would end this lecture today. It's a very important part of the lecture. The next lecture will cover IS and LM curve and how fiscal and monetary policies together are often determine, or how RBI's policy and central government's budget policy together often determines the short-run fluctuations, and how fiscal and monetary policies are being made by the economy's policymakers. Thank you.